Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we looked at a trade in Apple around their earnings event. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest. On Tuesday's Stock Play of the Day, we looked at Apple ahead of earnings. It was a purely speculative play, anticipating a good earnings announcement in Apple. We were a little bullish on that underlying stock based off of the chart pattern and just things in general going on in the space. And we looked at doing a back spread with calls, which is looking for more volatility as opposed to less volatility. Not necessarily picking a direction. We would have been better off if the market would have went to the upside. But overall, we just wanted the stock to move somewhere fast. The trade that we have is the back spread with calls. This is the actual back spread with calls inside the options playbook website. And the underlying stock when we put the trade on was right around strike B. So that's the valley of death in the back spread. And we learned from this strategy why they call it a pay later call. That's an AKA name for a back spread with calls, also known as a ratio volatility spread, and mainly because you do want volatility. You want it to go in one direction. Volatility doesn't necessarily mean it's going up or going down. It just means that it's going to move somewhere in a big fashion. And in our instance, we didn't get that move. So the underlying stock didn't move much at all. Kind of amazing because one of the things about Apple is they probably had one of their best quarterly earnings in the last 3 or 4 years, as far as blowing away the numbers. Analyst estimates came in at about 99 cents per share, and I think Apple was reported $1.44 per share. So quite a bit higher on the revenues, quite a bit higher on the earnings per share. Overall, and the stock just basically went nowhere in general. So great learning experience for the stock play of the day, because very rarely will we do a trade where it in this example here, we needed the stock in order for this stock to lose the maximum from this strategy. They needed to announce earnings and the stock not really move, and by that expiration date, this is the valley of death. If it lands right at our strike B on the expiration date, that would be the maximum that we could lose on that trade. So here's what happened with Apple. Here is the actual chart of the underlying stock. We have a 15-minute, 5-day chart. This was Tuesday. We tape the stock play of the day at noon Eastern time every Tuesday. So it is a live show. We have live quotes going on while we're taping the show. And we see where the underlying was at. It was right around 134. So we had a little bit of a run up during the show overall. But now on this would be Wednesday morning. This would be all day Wednesday. And then we see the big jump up on Thursday, but it only lasted for about 2 or 3 bars, which would be a half hour or so. Underlying stock ran as high as 137 very shortly after the open, came back down, traded right about where the underlying stock was at before the announcement, and then drifted southward a little bit. Right now, this is Friday. We see the underlying stock trading at 133. Now, ideally, I would have wanted to get out of this trade by the end of the day. Now, you could have, if you were quick, gotten out and actually even potentially made a little bit of money on the trade, but I highly doubt that you would have reacted that quickly because it came down precipitously. It didn't give you much time to actually exit the trade before it was trading right back at the strike price, strike B, if you will, by looking at the options playbook website, or basically right where the stock was at when we initially put on the trade. So let's go through and see where we're at. And this, once again, is highlighting on stock play of the day. we're just trying to learn here. We always build these as paper trades. And we did learn here because we're going to look at, well, the way we set up this trade, we went out a little further in time. That gave us a little bit of a buffer. We talked about the fact that the maximum you could lose was $6. We knew that. That would be the margin requirement on the trade. But what was our real risk of doing this trade? We're doing it purely speculative on earnings. And I would have definitely, if I was trading this, would have got out by the end of the day because it was very apparent that the underlying stock was going to just kind of hang around and not really do anything by the end of that day. And since it was an earnings trade, ideally I wouldn't mind being out if it went against me by that noon hour. But if I would have hung around for the whole day and I would have closed out this trade, we put it on for a net credit of 30 cents and we could have closed it out for $2 and about 25 cents at the end of the day. I got a quote on it at the end of the day, just so that I would have that information overall. So you would have lost about $2 on the trade. The maximum loss is $6, but if you get that, well, you basically also get the stupid award for hanging around all the way till the expiration date when we said that this is a speculative earnings play. So if you are still in that trade on paper, of course, if you look at it right now, this is the trade that we had set up. We went out 7 days. Well, when we started this would have been on Tuesday that we did the stock play today. So a couple of days back. But right now you have 7 days remaining. You have the weekend. There's going to be some time decay. Volatilities could come down a little bit. I would not want to be in this trade because we're in that area, that valley of death overall. So you would just basically close your trade, take your comeuppance, and move on to the next trade overall. But with that said, we sold the 128 strike call, very expensive call option at that point in time. And then we used those proceeds to buy two of the at the money calls, the 134 strike call. Right now, if we did that trade, it would be done for a net credit of $2.80. And the underlying stock is at 132.91. Worst case scenario would be that it stopped right at 134. So let's look at the profit and loss graph down here and take a quick peek at that. And you see that how close we are to that valley of death. We see that this red line has really dropped precipitously, which is this would be if we put the trade on right now. And ultimately, by next Friday, if it stays within this range, that's where our maximum risk would be at. So we would want to get out. We don't want to give the stock that opportunity. Could it go up? Could it go down? If it goes this way, that's great. If it goes this way, that's great too. All we need is about a 5-point move in either direction. Right now, you'd want it to be to the downside. Why? It's trading at 132 and some change. So we want it to go down below our short strike, which is the 128 strike call. And hence we would have made the maximum, which was about a 30-cent credit on the account. There's no reason to do that. That's not our plan. That's not what we were looking at. It's just interesting to see that we were incorrect in that we thought we'd get more volatility as opposed to less. And this kind of shows you, gives you a highlight as to if you're doing trades like this, what is my true risk if I get out the day after the trade, after that earnings announcement? It was really important that we went out to May 7th and didn't do that Friday expiration, which would have been this Friday today, because that time value has saved us a little bit on this trade overall. So let's do the official closeout paper trade. This was our initial trade that we put on. And if we're going to close it out, the sell to open would then become a buy to close. The buy to open would then become a sell to close. Now, highlighting here that this is a ratio spread. We're doing this as a net debit. This is one unit that's going to the trading floor. And we would be buying to close one of the 128 strike calls, selling to close two of the 134 strike calls. Right now, it's still at a net debit of we'll call it 280 to the account, $2.80. That means we put it on for a net credit of about 30 cents. So you would be down $2.50 on this trade. And you had the worst case scenario. The underlying stock did not move at all. It hung out right around the long strike of our call back spread, which is the worst case scenario. Very, very rarely are you going to have a stock like Apple have earnings announcement like they did, and the stock just decide to stay right where it was at and not go in either direction. Overall, just kind of hang out. But it happens, and that's why the stock market is what the stock market is overall. So this would be our official closeout paper trade overall. Try to do it for a net debit of 280 to the account. And don't forget, you got to pay commissions to get in and out of the trade. So you got to always factor those into the trade. But next time around, now we know a little bit more about the pricing of the option contracts. And if you're looking at a back spread with call, what is your true risk overall on that position? So it was a great learning experience overall. That's it for this edition of the Stock Play of the Day. Please don't forget to click subscribe and ring the bell, and we will see you this Tuesday at noon Eastern time for the next Stock Play of the Day. Thanks for coming, everyone.